funsupermart.com.
So I just want to start with your outlook for 2012. Where do you see Asian high yield and high yield in general sort of going for the year of 2012?
We're cautiously constructive about Asian high yield. We believe that companies in this region are actually going to face a more challenging operating environment this year. Nevertheless, we believe that they have enough financial resources to tide themselves over for this year. We do expect default rates to rise modestly, but it will still be low, versus the historical average. Nevertheless, we won't be surprised if we see, increasing negative rating migrations.
Okay, so against this sort of backdrop, what are some of the positive performance drivers that you see within the space that might drive the returns of this asset class?
Okay, we see three positive factors. One is the current low interest rate environment. Secondly, we see that Asian economies are actually doing a lot better than their developed market peers. Thirdly, we're actually paid more in terms of valuation for an Asian company versus its similarly rated US company. Firstly, on the low interest rate environment, currently against this current low interest rate environment and backdrop and uncertain outlook in the global macro outlook, we feel that investors are actually being pushed to look for higher yielding products. On the other hand, they also want lower volatility. And for this reason, corporate bonds in this space actually provide you both. They are actually paying you a significant pickup compared to deposit rates, but they are also lower volatility compared to equity. And hence, they are positioned quite well and in a sweet spot, as it were.
Okay, so if we go to the flip side of the coin, what are some of the risks that investors need to be aware of before they jump into this asset class?
Okay, Asian high yield tends to have a lot more idiosyncratic or issuer-specific risk. But currently, we are mindful of two key risk factors. One of them is the liquidity profile of the companies, and the other is corporate governance. For liquidity profile, we're a little bit more concerned about companies which are actually having any imminent refinancing risk this year, because they might have problems coming into the market and refinancing this debt. We also think that if they face a downturn in their particular industry, say for example the steel manufacturing or shipping, for example, they may also compound this problem, their difficulty in accessing capital markets. The other thing that is a particular concern in Asia is corporate governance, as we have had quite a few high-profile corporate failures due to poor corporate governance.
Okay, so taking all of this into account, the outlook as well as the positive and negative drivers, how is the portfolio positioned to ride this out?
Well, currently we feel that Asian high yield is only fair value at best, so we believe it's currently a very good carry play proposition, and so we tend to invest in names which give us stable returns. Having said that, if market were to sell off significantly and valuations were to return to become more attractive, we would be adding on more risk, because this would then improve the capital gains proposition. Having said that, we believe that stock selection is still a very important factor in terms of driving the performance for Asian high yield. But broadly speaking, we like Indonesian coal companies. We also like Philippine corporates for its defensiveness. We do like Chinese properties because of its debt risk reward profile. We believe that we are being paid sufficiently for the headwinds in the sector. We are shying away a little bit from Chinese industrials because of the corporate governance issues.